Iran promised to open the Strait of Hormuz, and they knowingly failed to do so, the president writes. This caused anxiety, dislocation, and pain to many people and countries throughout the world.
And look, there's a 21-mile gap at the bottom of the Persian Gulf called the Strait of Hormuz. It's been in the news. 20 million barrels of oil pass through it every single day. That's 1 out of every 5 barrels on the planet. And right now, functionally, it's closed. The headlines will tell you it's open. There's a ceasefire. Diplomats are shaking hands. The word peace has been used. But here's what the headlines won't tell you. The ships aren't sailing. The insurance companies won't cover them. The crews won't board them. And the routing costs make it financially insane to try. So the Strait of Hormuz is open, the same way a restaurant with no kitchen staff, no food, and an active vocal colony of raccoons in the dining room is open. The sign says yes. Reality says you're gonna get rabies.
Effective immediately, the president states, the United States Navy, the finest in the world, will begin the process of blockading any and all ships trying to enter or leave the Strait of Hormuz.
And there are 2.6 million barrels a day in bypass pipeline capacity against 20 million in flow. That's like trying to reroute a fire hose through a cocktail straw, like trying to push a fully grown St. Bernard through a cat door. It doesn't work. It's upsetting for everyone involved. And no amount of political will changes pipeline physics overnight. But this is bigger than oil. So while every other channel is arguing about who started what and whose fault it is, I want to show you where the money is actually moving. Because there are 7 assets repricing right now because of this choke point. Some are obvious, some you've never heard of. And one of them you probably already own and don't realize is working in your favor. So here's how I'm going to structure this list. First, I'm going to go over the obvious plays. These are the front page assets, the ones CNBC anchors shout about between pharmaceutical commercials. Second, the hidden channels. These are the assets surging through the back door that nobody on financial TV is connecting to Hormuz. And one that's going to make you say, wait, what? And then finally, the contrarian play. The one asset in your life that's quietly getting more valuable every single month this crisis continues. Dave Ramsey would hate this one. And when I'm done, let me know which one you think will surge the most. Let me know down in the comments. Number 1, crude oil. This is the layup. Hormuz moves 20% of the world's oil. The bypass can handle about 13% of that flow. The math, it doesn't math. So global benchmarks reprice. Crude hit nearly $128 a barrel in early April. The EIA just raised its 2026 forecast by 22%. Now here's what most analysts miss. Oil stocks don't move the same day oil prices do. They lag by about 2 quarters because stock prices follow earnings and earnings follow realized prices. In 1973, during the Arab oil embargo, crude rose 300%. Oil equities didn't catch up for 6 months. So if you're watching energy stocks and thinking, I missed it, historically, you haven't. The equity re-rating comes later. And if you're thinking, but Matt, aren't we energy independent now? Yeah, I hear you, but energy independent doesn't mean price independent. Oil is priced on a global benchmark. When the marginal barrel gets more expensive anywhere, it gets more expensive everywhere. You can be the biggest producer on the planet and still pay more at the pump. That's not politics, that's just commodity pricing 101. Now number 2, liquefied natural gas, LNG. Everyone thinks Hormuz is exclusively an oil story. It's not. About 1/5 of the world's LNG trade flows through that same strait. Most of it from Qatar, the world's largest LNG exporter. And Europe is in trouble. Their gas storage is at a 5-year low right now. They need roughly 700 LNG cargo shipments just to refill for next winter. And the primary supply route runs straight through the raccoon-infested restaurant. European benchmark gas prices surged. Asian LNG prices jumped as much as 68%. This isn't just an oil story. This is a what heats your home and powers your factory story. And it's getting worse, not better. Number 3, tanker freight and shipping stocks. This is where it gets interesting because even the oil that is still moving costs dramatically more to move. War risk insurance premiums on tankers transiting the Gulf surged over 1,000%. One analyst estimated hull war risk costs jumped from about 0.25% to 3% of vessel value. Here's what that means. A $100 million tanker now costs $3 million just to insure for a single voyage through a conflict zone. Before the war, it was $250,000. That is like paying $1,000 a month for car insurance on a 1998 Honda Civic just because your commute involves driving through an active Renaissance fair jousting tournament. And this isn't new. During the 1980s tanker war between Iran and Iraq, very large crude carrier rates briefly spiked 800%. Same mechanism, different decade. The ships are the arteries, and when the arteries get expensive, everything downstream costs more. Now, the hidden channels. Number 4, fertilizer. And this is where it starts hitting home, because about 1/3 of global nutrient trade passes through the Strait of Hormuz. Urea prices have jumped nearly 50% since the war started. Ammonia is up over 20%. One set of analysts said nitrogen fertilizer prices could roughly double if this drags on. And what most aren't considering, the grocery inflation you're feeling right now, that's from last quarter's disruption. Fertilizer price shocks take a full growing season, 3 to 6 months to transmit through the food supply chain. The disruption happening today hits your grocery cart in October. It's an economic time bomb wrapped in a plastic grocery bag. And this is the kind of second order effect that Warren Buffett has talked about for decades. He doesn't care about oil futures. He cares about what oil does to the cost of everything Berkshire's companies sell and ship. The downstream damage is where the real money moves. Number 5, aluminum. Quick one. LME aluminum hit a 4-year high, roughly $3,500 a ton, on supply fears. Aluminum is the Steve Buscemi of elements. It's in absolutely everything. Packaging, cars, construction, wiring. It does all the heavy lifting, and it never gets top billing. It's the Hormuz effect in a nutshell, invisible until it's in your bill. Now this next one, it's going to surprise you because everyone is telling you to buy gold when a war breaks out. And here's what actually happened. Gold dropped in the early days of this conflict. So number 6 is the US dollar. And I know that breaks people's brains. War is supposed to be good for gold. And it is, eventually. But in the first wave of a crisis, big institutions sell everything to cover margin calls. Gold, stocks, bonds, all of it. Gold didn't fail as a safe haven. Gold got mugged in the parking lot during a liquidation fire sale. And while it was getting mugged, the US dollar quietly became the real war asset. Crazy stuff, I know, but follow the chain. Oil goes up, that makes inflation sticky. Sticky inflation means the Fed can't cut interest rates. Higher rates mean higher yields. Higher yields attract global capital into dollar-denominated assets. The dollar strengthens, not because of patriotism or politics, because of yield differentials. Now, I'd be lying if I told you this was a clean, unanimous call. It's not. Ray Dalio agrees on the short-term mechanics. The dollar strengthens when yields rise. But he's also publicly warning that Iran letting certain tankers through in yuan instead of dollars is the beginning of something bigger. A slow, deliberate move away from the dollar as the world's reserve currency. And he might be right, long term. But right now, today, the yield math is the yield math, and the dollar is winning that fight. Whether it wins the longer war is a different video entirely. Now, retail investors buy gold on day one. The macro funds, they're buying dollars, tanker futures, and fertilizer producers because they understand how the shock actually works through the system. And I know some of you are pushing back. I mean, you might even be screaming at the screen and shaking your head.
Come on, Matt, gold. It's the deal. It's the real deal.
And that's a fair point. You know, Ray Dalio would put gold at the top of this list. He's been recommending 10 to 15% portfolio allocation specifically for this kind of scenario. Warren Buffett, however, wouldn't touch it with a 10-foot pole. He's never liked gold, calls it an asset that just sits there and stares at you. So, who's right, Ray or Warren? Well, that depends on your time horizon and what you believe about the dollar long term. But that's exactly why I left it off this list. When the 3 smartest investors alive can't agree on it, I'm not going to pretend I have the answer. What I do have the answer on is number 7. And this is the one, your fixed rate mortgage. And I know this sounds insane. How is debt an asset that surges? And if you're really paying attention, you probably caught something. Didn't I just say the dollar is getting stronger? So how is inflation eating your savings at the same time? Well, both are true. And here's how. You see, the dollar is getting stronger against other currencies. The euro, the yen, the pound. That's the yield trade. But strong against the yen doesn't mean strong against your grocery bill. Those are 2 different fights. And that's exactly why this one matters. Here's the math. Your mortgage is a fixed dollar debt. You owe, let's say, $250,000 at 4%. That payment never changes. But inflation is eroding the real value of that $250,000 every single month. And the asset underneath it, your house, is repricing upward with inflation. You are effectively shorting the US dollar through your mortgage. Every month this war pushes inflation higher, your debt gets cheaper in real terms and your asset gets more valuable. And that's not my opinion, that's arithmetic. Now I know math is not an exact science, but for what it's worth, both Buffett and Dalio agree on this one. Buffett has said publicly that a 30-year fixed rate mortgage is one of the best financial instruments available to the average American. Dalio's entire framework on debt cycle says the same thing. When inflation runs, fixed rate borrowers win. These two disagree on almost everything, but they agree on this. And this already happened. After the 1979 Iranian Revolution, oil prices doubled. Mortgage rates eventually hit 18%. But the homeowners who already had fixed rate mortgages locked in at 8 or 9%, they won the decade. Their real debt burden got cut in half while their home values doubled. They were the ones who came out ahead. So people who followed the safe advice, pay off your debt, sit in cash, buy bonds, they got their purchasing power eaten alive by exactly this kind of supply shock inflation. And the people who carried fixed rate debt against hard assets, they used inflation as a tailwind. That's called inflation arbitrage, and it's working right now, today, in your favor. If you have a fixed rate mortgage, this war, as ugly and uncertain as it is quietly making your financial position stronger every month it continues. So, what now? Well, watch tanker day rates and fertilizer futures. If they hold at double their pre-war levels for 90 days, you're in the structural scenario. The floor has moved. Prices, they're not coming back down. If they normalize, the trade dies and this was a temporary spike. We don't bet on headlines though. We watch flow, freight, and fuel spreads. Now, another investor, a quant like Jim Simons, would tell you that by the time this thesis is on YouTube, the algorithms have already priced it in. And for some of these, yeah, maybe. The oil spike, probably priced. But the fertilizer lag hitting grocery bills in October, the equity re-rating that takes 2 quarters to show up, your fixed rate mortgage quietly gaining value every month, those aren't priced in. Those are structural. And they take longer than an algorithm's attention span to play out. Now, you can reposition now while the data is still developing, or you can wait until the evening news tells you what the smart money figured out 6 months ago. But sitting still is the one move that probably puts you last in line. And here's the thing I want to leave you with. The Strait of Hormuz isn't just a choke point. At its narrowest, the actual navigable shipping lanes inside that 21-mile gap are only 2 miles wide in either direction. A usable waterway the width of Central Park. 20% of the world's oil, the energy that keeps the lights on, the hospitals running, and your deliveries arriving, is entirely dependent on a passage you can almost see across from the shore. We built a global economic superpower that can be crippled by a traffic jam. And that traffic jam is doing something that nobody's talking about. It's sorting people. Some of these 7 assets are making certain people wealthier every single month this crisis continues. And the same crisis is grinding everyone else down. Higher groceries, higher insurance, higher everything, with no relief in sight. Same economy, same war, same choke point. Completely different outcomes depending on what you own. That split has a name, and it's accelerating faster than most people realize. I made a full breakdown of exactly how it works, which side you're on right now, and how much time you actually have left to get positioned. I put it together for you in this one right here, because the 7 assets I just showed you, they're symptoms. What's causing them to split apart, and what that means for your financial future over the next 2 years, that's the part that matters most. And I walk through the whole thing right here. God loves you, and so do I. Take care.